Ira Epstein with your financial market wrap-up, and this wrap-up is for the last trading day of August 31st, 2022, 5:45 p.m. Well, we keep seeing the stock market leaking away. You know, during the day, we had an attempt early on this morning when you saw the ADP data come out at 132,000 jobs. The market rallied. I think it lasted 10 minutes, and then it nosed-dove. The reason they were looking, or the trade was looking for as much as 300,000 jobs out of ADP, seeing 132,000 got the guys that keep thinking the Fed, they don't know what they're saying. They're going to back off no matter what goes on. And they said, there's that lower jobs number. Boom, they bought. I said they had 10 minutes of glory and the market punished them the rest of the day. On the energy market, this thing that's weighing on stocks and this concern about all the economies slowing down is now gotten into the energy prices. They're breaking down, not on bonds and notes. The lower they go, the higher real rates are, you know that. You get investments like Bitcoin and the metal markets here. Why? I mean, inflation hasn't moved these markets higher. You think it has? Bitcoin's gone from 69,800 or whatever down to the 20,000 range. Gold got up over tried to get up to $2,000 and just failed away from there. War doesn't seem to be doing it. And now you got the Fed committed to one thing, breaking the back of inflation. And you think that you should buy metals on that. I'm reading the ads that I get in my email box. Buy gold, inflation hedge. I don't think it's working that way. That's been my point. Certainly, energy prices have worked that way, but I can't say that about the precious metal. Now, when we come to the S&P, this is your first move now under the 18-week average of closes. So the market is shifted. It's taken it a while. On a weekly basis, it's now made the shift, and you are underneath that, which means you have a downside bias until you close back over it. When I come to the daily charts, it's hard to deny it's just been a leaking affair ever since last Friday. You've got the lower highs, the lower lows. The chart action is just bearish. The market is underneath the 18-day average of closes. It didn't even pay attention to the 100. What it did pay attention to was the combination of that and the 100. But even from there, it's leaking away. So now it's running on its own. And I know chartists will tell you, it's going to go into the next area. And they're right. That area is this zone here that's culminated, let's call it the 39,000 level. That seems to be between that and 3850. The next zone that the market wants to be dragged down to, and that seems to be how it's feeling. You're not embedded, you're oversold, and via this setup, you cannot embed before the end of business Friday. Whoa, that means you'd have to go through the jobs data report in order to know, do you get your embedded reading or not? I'll be on vacation. I'm being facetious, I'll be here. But trade-wise, in these stock indices, I'll be on vacation. Look at the NASDAQ. If you and I take a look right here, and this is today's close. Both numbers are over 80, right? But both numbers are under 20, I meant to say. Both numbers under 20, not the day before. So the market's going to make me wait to see, can I get all the numbers set up through Thursday to embed, and then the potential sell signal would be right into the jobs data. Well, I like that. First of all, I wouldn't go into it with a position. But let's assume the jobs data creates a rally and you stay embedded. Now I've got my sell opportunity. I'm just giving you the make-believes and the what-ifs. You start thinking ahead for setups. In the Dow, you don't have that exact setup. You can't count today because we don't know what Thursday is going to be. And you only have one day where both numbers are under that 20 level. So nothing to do there. Russell will be the same way. So all of the stock indices, while they're into support zones and so on, they have the potential to give you embedded readings. You get embedded readings, and I got to tell you, then I start wondering, are we going to attack these June lows? I didn't say you have to do it on one swoop, but it's like adding fuel to a fire. if you get them. The converse, and there's always a converse, is if you get the reading and you lose it, you get that short covering rally that carries it back in the main moving averages. You're at a real funky time in the market. Be very careful. In the VIX, the resistance I pinpointed for you, upward from the 200-day average, the 100, and the upper Bollinger Band, on the money. And I'm going to repeat, I'm bothered that this index isn't much higher, back into the, say, 35 level. If the market were really scared that it's going to take a nosedive even further, where are the buyers for that premium, that risk premium? I'm not seeing it there. That's bothersome. When I look at the 30-year bond, embedded reading still going one way. The market breaks down each day and makes a lower low. If you've taken my enhanced Bollinger Band course, which there'll be an add-on for it right after this, you learn the importance of that. You learn how to work with this. But this is a very bearish signal until the red line closes over 21. Rallies look to me to be selling opportunities. Same in the 10-year notes. See, what I like about this work is it anchors you into the bear side of it. And you can see what it's doing here. When we get to the dollar index, I'm still anchored on the bull side. Now, I'll lose that if the red line closes under 79. Then I'll have to rethink my position. But right now, the pullbacks in the market are still acting like buying opportunities. And in the euro, you lost, past tense, the embedded reading. Follow me here. Here is the market yesterday. You closed at 2010. Today, you had to lose the embedded reading in order to do what? In order to stay bearish. You got a 26 reading. You're out. You formally have lost it. My work says that before you get through this low, you should get back up to that 18-day average of closes. We'll see what happens. And remember, 40% of the weighting of the dollar index is the euro, which tells me, okay, while that dollar is hanging there, it's probably going to break down if this is going up. So you start formulating your plan, and maybe I'm saying, okay, more of a short covering rally, a break in the dollar. I can trade other indices if that's what I want to do, such as the British pound, which has a fully embedded reading. I'm certainly in the bear camp here. In Bitcoin, you have an embedded reading. Embedded readings, you're looking for Bollinger Bands. This is why I'm mentioning this course action so frequent this week. You've set up upon setup here and in the ETFs. Learn how to work with these setups. They're just handing you a chart picture you want to learn. Then we look at the energy market and look at how you're starting to roll over. So you got up towards the 675 level differential. You pulled back, and that's not a surprise to you or me. What did we do just the past 48 hours back here? We got up to the combination of the Bollinger Band 100-day average. The smart money comes out of the market, not embedded. Idea is that you fall back and regroup. Well, now you've gone to the 18-day average. You're in the regrouping process. Same thing on WTI. You got up to these key averages. You pulled right back into the regrouping process. Nothing to do. You watch, you see. And again, Bollinger Band, not embedded, out of the market. That's what you learn in that course. Gasoline, out of the market. I don't care that it went further. It's not about lows and highs. It's about zones. Based on the number where these numbers happen with you, are you oversold? You are. So let the other guy get bearish as can be down there while it's oversold. You don't need it. What are the odds of staying under a Bollinger Band? 5% of the time. And as I teach you, you can count each consecutive close and then take away one of those 5 percentage points. You go down to 4, 3, and so on. Gives you a pretty good idea as to what's going on. In the nat gas, this is all a market that's pulled back to the 18-day average, refusing to settle under it to throw out a full-fledged sell signal, and it's just trying to find against that line in the sand what it wants to do next. You hear me keep talking about the importance of Bollinger Bands. I was doing it back here. You never did embed. And when the market came up, I still remember one of my clients wrote me, and it went even higher. And I felt terrible until this happened. And he wrote me the other day, and he's quite happy. And the reason was, I said, you're not embedded, you're against that. You're getting a delayed reaction. It's probably going to pull back. And that's what happens. Learn to play with it the way I do. Take a look at this.